Welcome back to our Forex Fundamentals series. In today's lesson, we're answering a key question: who really drives the Forex market? The Forex market is the largest financial market in the world, moving trillions of dollars every day, and behind those movements are different groups of powerful participants. Let's break them down. Central banks and governments. At the top of the hierarchy are central banks and governments. Think of major players like the Federal Reserve, the European Central Bank, the Bank of Japan. These institutions control monetary policy, interest rates, money supply, and interventions. When a central bank raises interest rates, the country's currency often strengthens. When they cut rates, the currency usually weakens. Their decisions shape the entire Forex landscape. Commercial and investment banks. Next up, commercial and investment banks, the most active entities in the FX market. They facilitate currency transactions for corporations, governments, hedge funds, retail traders. But they also trade currencies for their own profit through proprietary trading. Their massive transaction volumes make them key drivers of short-term price movements. Hedge funds. Hedge funds are another influential force. These funds control billions in capital and use strategies based on macroeconomic trends, technical analysis, high-frequency trading. Because of their size, hedge funds can quickly move markets, especially during times of economic uncertainty. Multinational corporations. Big-name companies, like Apple, Toyota, or Shell, also play a major role. They participate in Forex to pay international suppliers, receive foreign revenues, hedge against currency fluctuations. For businesses operating across multiple countries, even small currency movements can affect profits. Retail traders. This group includes individual traders like you. Thanks to online trading platforms, anyone can participate in the Forex market. Retail traders trade for speculation, investment, income generation. While individually small, together they contribute significantly to overall liquidity. Market makers. Market makers are financial institutions or brokers that provide liquidity. They quote both buy and sell prices, ensuring trades can be executed instantly. They profit from the spread, the difference between bid and ask prices. Without market makers, the Forex market would be slower and far less efficient. Speculators. Speculators include day traders, swing traders, algorithmic traders, anyone trading purely to profit from price movements. They don't need the currency for business or travel, they just want to capitalize on volatility. Speculators help create the liquidity that keeps Forex running smoothly. NGOs and everyday currency exchange. Finally, you have smaller but still important participants, non-governmental organizations converting funds, tourists exchanging currency, international students and workers sending money abroad. These everyday transactions form the backbone of the global FX market. Understanding who participates in the Forex market helps you interpret price movements, market sentiment, and major trends. In the next lesson, we'll dive deeper into how currency pairs work and how to read exchange rate quotes. If you found value in this video, make sure to like, comment, and subscribe for more Forex fundamentals. See you in the next lesson.